Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street delivered right after the closing bell. Please note this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in.
Well, today it was quite the reversal, a really sharp risk-off move that basically erased all of yesterday's gains.
Yeah, a total wipeout. It felt like sentiment just flipped completely back to defensive positioning.
It did, and the reason was pretty clear. Some really jarring news on the labor market front.
Right, that Challenger, Gray, and Christmas data. It really seemed to hit the market hard. Just yesterday we were looking at better ISM services, decent ADP numbers.
Exactly. That suggested maybe things were holding up okay. But this Challenger survey, well, it's a leading indicator for what companies intend to do regarding layoffs.
And the intentions look grim.
Grim is putting it mildly. October job cut announcements surged 175%. compared to last year.
175%. Wow.
Yeah. We're talking 153,074 announced cuts just in October. That's the highest number for an October since way back in 2003.
Yeah, it's a big number.
And the bigger picture isn't much better. For the first 10 months of this year, 2025, total layoff announcements have already crossed 1 million. That's up 65% from the same period in 2024.
So much for the soft landing narrative then. That feels like a splash of cold water.
It certainly does, and there was a specific detail in there that I think really caught people's attention, the AI factor.
Ah, yes, the artificial intelligence impact. What did the data show there?
It showed that over 31,000 of those October job cuts, 31,039 to be precise, were specifically attributed to AI displacing workers.
31,000 in 1 month linked to AI.
Directly. And this isn't just, factory automation. This seems to be hitting white-collar knowledge worker type roles. It suggests this weakness might be more structural, not just cyclical.
That is a different kind of worry. And you can see the market react almost instantly, right?
Yeah.
Suddenly everyone's expecting the Fed to step in.
Oh, absolutely. The odds priced in for a December rate cut jumped significantly. Last I checked, it was up to around 72%.
72%, even after Chair Powell tried to sound a bit more hawkish recently.
Doesn't matter. The market heard this labor data, especially the AI angle, and immediately started pricing in a slowdown and the need for easing. It's classic volatility whiplash.
And this whole government shutdown situation isn't helping, is it? Creates a data vacuum.
Exactly. When official data is delayed, the market puts even more weight on private surveys like Challenger. It just amplifies the reaction, makes things choppier.
Okay, so let's look at equities. How did this risk-off mood play out there? Tech clearly got hit hardest.
Yeah, textbook risk-off. The NASDAQ composite plunged 1.9%. That was much worse than the S&P 500, down 1.1%, or the Dow, which fell about 0.8%. High-growth, high-beta names led the way down.
Any specific examples jump out?
Well, NVIDIA dropped 4.2%. There were some comments floating around from David Sachs suggesting the AI industry shouldn't expect a federal bailout. That kind of talk spooks chip investors.
Yeah.
And Microsoft slipped too, down 1.9%. Maybe some of that initial excitement around the big OpenAI partnership is just, cooling off a bit.
We also saw some real pain in consumer discretionary. It feels like the market is being incredibly selective right now.
Very selective. Look at DoorDash. It plunged over 15%. Why? Because they warned about spending more on product development in 2026. The market punished that outlook.
Punishing future investment.
If it potentially impacts near-term profits, yes.
Mm-hmm.
And ELF Beauty crashed 22%. They actually beat earnings estimates, but their full-year guidance was weak, down 22%.
Ouch. And CarMax tumbled too, didn't it? Over 10% on a CEO change.
Yeah, surprise CEO departure, another sign of market sensitivity, but, amidst all that red.
There's always a green shoot somewhere.
Well, today there was a big one, Datadog, DDOG. It surged over 20%.
20%. In this market, what did they do?
They absolutely crushed their quarterly numbers. Revenue came in at $886 million when analysts were expecting something like $852 million. That's 28% year-over-year growth.
So the market will reward growth, but it has to be profitable and delivered now. No more paying for promises.
That's exactly the takeaway. Concrete results, profitability expansion that gets rewarded. Everything else gets punished.
This kind of divergence, though, Datadog soaring while so many others fall, brings us to market breadth, right? That's a big concern.
It is probably the biggest technical concern right now. Market breadth basically asks, how many stocks are actually participating in the index's move.
Okay.
So the S&P 500 index itself, it actually closed above its 50-day moving average today. That's a key technical level, around 6,660. And it's been above that level for 144 straight days. On the surface, the index looks okay.
But underneath?
Underneath, it's a different story. Only 40%, 0% of the individual stocks in the S&P 500 are trading above their own 50-day moving averages.
Only 40%. That sounds narrow.
It's the narrowest reading we've seen since 2003. It means the index is being held up by a very small number of mega-cap stocks, mostly tech. Think Apple, Microsoft, NVIDIA. The rest are lagging significantly.
So the rally is basically standing on a few pillars. If one of them wobbles because of macro news like today's labor data.
The whole structure is vulnerable. It's a point of fragility. Quick aside before we move on, the Tesla shareholder vote on Musk's pay package.
Ah, yes. Lots of drama there. What's the verdict?
Well, the prediction markets, places like Polymarket and Kalshi, had the approval odds incredibly high, like over 90%, despite all the governance concerns. Seems like it passed, but the debate isn't over.
Okay, let's shift to fixed income. With risk-off sentiment and those Fed cut odds jumping, bonds must have caught a bid.
They certainly did. It was a complete reversal from yesterday. The 10-year Treasury yield fell back pretty sharply, down over 6 basis points to around 4.089%.
Wiped out yesterday's rise.
Completely. And the 2-year note, which is really sensitive to Fed policy expectations, dropped 7 basis points to about 3.562%. That tells you the market is actively repricing for slower growth, maybe even recession risk.
But here's the disconnect I see. Stocks are shaky, bonds are rallying on recession fears, yet credit markets seem pretty calm.
That is a really important contrast right now. Credit spreads, both investment grade and high yield, are still near historic lows. Investment grade is around 78 basis points over treasuries, high yield about 281.
So bond investors aren't panicking about companies defaulting.
Not yet. It reflects the fact that corporate balance sheets, broadly speaking, are still quite healthy. We saw that in the strong Q3 earnings season, 83% beat rate.
Yeah.
But those tight spreads mean there's very little cushion. If this labor market weakness starts hitting company earnings down the line, the credit market could reprice very quickly and very painfully. There's just no room for error priced in right now.
And all this is happening against the backdrop of the seemingly endless government shutdown, day 37 now.
37 days, longest ever. And aside from the data blackout intensifying market volatility, we're seeing real-world operational impacts.
Like the FAA flight cuts.
Exactly. The FAA had to cut flights at 40 major airports because of air traffic controller shortages, which are worsened by the shutdown. And you hear reports about SNAP funding potentially running low this weekend. The pressure is definitely building for some kind of resolution.
Okay, let's check in on some other assets.
Sure.
How did crypto handle the risk-off mood, Bitcoin specifically?
Well, it definitely felt the pressure. Bitcoin's trading around $101,061 now. It did dip and test that big psychological $100,000 level earlier this week, holding above it for now, but that level is key.
Is there anything interesting happening beneath the surface, like with who's buying or selling?
Yeah, the on-chain data is pretty fascinating. It shows what looks like whale accumulation happening while smaller retail holders are selling off.
So big players buying the dip from smaller sellers.
Kind of looks that way. We saw about 37,000 smaller wallets selling positions, but at the same time, 231 new wallets holding 10 or more Bitcoin were created, suggests some larger, maybe institutional players see value here.
Interesting. What about commodities? Oil seems stuck in its own world.
It really does. Crude oil, WTI, is still weak, near $59.58. Even with risk off today, the fundamental picture for oil is just so bearish.
Supply surplus concerns.
Massive ones. The IEA is projecting a big global surplus for 2025 and 2026. That supply story is just overwhelming everything else for crude right now. Gold, on the other hand.
Holding up better.
Yeah, gold's hanging in there near $3,981. It had its correction back in October. Its relatively calm reaction today suggests maybe the speculative froth is gone, and you still have that underlying support from things like central bank buying. They bought another 220 tons in Q3.
Okay, and last check. Real estate. Did the bond rally give mortgage rates a break?
Not really, unfortunately. The relief seems to have stalled out. The average 30-year fixed mortgage rate actually ticked up slightly today by 2 basis points to 6.22%.
It's still sticky, and still a challenge for affordability.
Huge challenge. The national median home price is sitting around $415,200. At 6.22%, your basic principal and interest payment is roughly $2,040 a month. That's tough relative to incomes. Pending home sales are still pretty sluggish.
And quickly on commercial real estate, still a mixed bag.
Very much so. The office sector remains under serious pressure. Vacancy rates are high, around 19.6%, and delinquencies on office CMBS loans hit 11% at the end of last year. But other areas like industrial properties, warehouses, and even shopping centers were doing relatively okay. It really depends on the property type.
Okay, let's try to wrap this up. What's the bottom line from today's action?
I think the bottom line is vulnerability. The stress in the labor market, which was kind of obscured by the government data blackout, seems to be real. And it's hitting a market structure that's already fragile because of that extremely narrow breadth we talked about.
Makes sense. So looking ahead to tomorrow, what are the immediate catalysts?
Key things to watch. The Bank of England rate decision. The market's pricing about a 40% chance of a cut there, so that could move global yields. We'll keep listening to any Fed speakers for clues on that December meeting. And of course, any signs of movement on ending the government shutdown. The pressure seems intense now.
And for listeners trying to gauge direction, what are those key technical levels again?
For the S&P 500, that 50-day moving average around 6,660 is critical support. Below that, things could get technically weaker. For the 10-year Treasury yield, keep an eye on 4.00%. A break below that would signal a stronger recessionary pricing. And for Bitcoin, $100,000 is the big psychological floor to watch.
All right, before we go, let's circle back to that AI job displacement point. If that Challenger data is right, and AI is causing significant structural white-collar job losses, what does that mean for the Fed? Can rate cuts even fix that?
That's the really big question, isn't it? If it's structural change, not just a cyclical downturn, then traditional monetary policy might be less effective. A rate cut helps boost demand cyclically, but it doesn't necessarily retrain workers or create jobs immune to AI. It could mean we're facing a longer period of labor market adjustment and maybe market fragility than people expect. Even if the Fed does cut in December, that's a deep uncertainty the market is just starting to wrestle with.
A sobering thought to end on. That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.